keep finding ways that we're helping partners finding either, balance in their life or focus or purpose.
Practices that are going to help improve your project management skills or your finances.
We're here to talk about setting long-term goals and then how to achieve them.
Increasing your quality, therefore becoming the best place in town to work.
Welcome to Academy Live.
%33% of Americans wait until the last minute to do their taxes. I'm not sure exactly how they measured last minute, but I feel pretty proud of myself for finishing these tax lists last weekend, which was a whole 3 weeks early. We are here today with Brad Gross to talk about taxes, and hopefully you're getting ready to file soon, and we will have some helpful advice for you. We're looking forward to some pearls of wisdom from our very own Brad Gross, who will be visiting with us today, talking about all the different tax issues that MSPs face. We really appreciate Brad for coming to talk to us, taking some time out of his busy schedule to meet with us. Rex is off today, so it'll be just me and Chris. Let's check out the quote of the day. Chris, do you mind sharing our quote? Let's take a look at it.
I would be happy to. I love this part of this segment. Nothing is certain except death and taxes. Benjamin Franklin. So appropriate quote for today's topic, right?
Yeah.
We know every year it's going to happen. We know, it's something we have to plan for that. We talk a lot in the show about being strategic and about planning. So we know that's going to happen. But on a more lively topic, we'll talk about taxes. Any comments, Bessie?
Yeah, I think it's something that, especially if you're new to business, there's a lot of different things that you might not be considering when it comes to taxes. So hopefully we'll be covering some of those different aspects and how you can prepare throughout the whole year, not just these last few weeks before the deadline, what you need to know. So I'm really excited today. I think we can now bring on our guest.
Brad, welcome. Great to see you. How you doing today?
Good to be here, guys. Thanks for having me on.
Yeah, thank you so much for coming.
Even though we're
it's
talking
going to be
about
great.
tax. I mean,
well,
you're gonna make
that's why we invited you. We knew that you'll make kind of snooze fest sometimes topic into something exciting. So
I'm going to turn this tax thing into a rom-com is what I'm talking about.
Oh my goodness.
It's going to have, you're going to laugh, you're going to cry, all things.
It'll be better than Cats.
Better than Cats, better than E.T., better than Gremlins. How's that? That's the bar I'm setting here.
Okay? I can't imagine somebody better than you to do that. So absolutely.
Well, Brad,
we'll
we ask every guest to start off with a humble brag. Tell us a little bit about yourself.
A little bit about myself and being humble about it. That's
try
impossible.
Your best.
I'll here we go. So, first of all, thank you for having me on. About me. So my law firm, self-titled law firm, counsel service providers, managed service providers, technology service providers, nationwide, in fact, some globally. I have the honor of saying, though it's not a formal poll, but I feel pretty confident in saying that we have counseled more MSPs, more service providers than all law firms in the U.S. combined. Literally thousands and thousands of them over 23 years. So I started programming on this. Am I pointing? There it is. This is not a fake background, by the way. Everything you see here is real, including the Jason doll. That is a real, okay? So I started on that TRS-80 Model 1 Level 2 in 1979. So I've been doing this a while. In doing that, we've pretty much seen all the issues relevant to service providers, not just taxes, but service agreements and employment and corporate and merger and acquisition and so on. So we're pretty much prepared to talk to you guys about anything you want, including the issue of the day, the issue du jour.
Excellent. Yeah, I know we're going to get really into the taxes. I know. Will you just give a quick overview for anyone? Is like, how do lawyers get involved in this topic? Like, why do we ask you on versus an accountant, for example? Can you just give a little introduction there?
Sure. So, and I'm going to start off by saying, even though we do a lot of tongue-in-cheek stuff here, I'll start off by saying that what we're talking about today is not tax advice. Okay, so we're not telling people things that they say, oh, I'm going to do that, and then they run off and either file taxes or don't file taxes or don't charge tax, and they say, I saw it on a Paxate video. No, we don't want that. Okay, so everything that we're going to talk about is sort of informational, educational. It'll get you thinking in terms of what you can do and what you should be doing. But again, you're going to want to involve a tax attorney or a tax, an accountant, right, for those final decisions before you sort of run off and do things. So when do lawyers get involved in taxes? Largely, it involves either, two categories. One, when they sell something, right, like a business, sale of assets, sale of stock, whatever it is, the attorneys will get involved in the tax end of things, always working in conjunction with an accountant. They'll also get involved when it comes to sales tax. When an MSP will say, am I supposed to be charging sales tax? This state says I owe them sales tax. What's that about? So those are the two overall areas. And then, of course, it's just good business planning for an attorney to ask their client, his or her client, about, are they planning properly? Are they doing proper bookkeeping and so forth? Because improper bookkeeping, as we're about to explore, can often expose the owner of a business to personal liability. So we don't want that. So we want them to do things correctly. That is when we get involved.
So Brad, we kind of talked about, kind of three main things we wanted to touch base on. One was kind of, year end. We talked about reducing tax burden, and we talked a little bit about avoiding mistakes. So if we talk about this first one, we're in April. Everyone, we're right around the corner from April 15th. That's when everybody thinks about it. We all associate April 15th, IRS, tax day, things like that. But what are some things you've seen, businesses and MSPs do in planning ahead? Not necessarily April, but September, October, November, December. What are some key things you've seen people do successfully months in advance before the end of a year to help set themselves up in a good way for tax preparation?
Sure. So that goes to the heart of good bookkeeping principles, right? Good bookkeeping processes and procedures that have to be implemented. And along those lines, it is not enough to simply have a bookkeeper and assume that everything's being done right. There are some things that a company can delegate, and there are some things you can't. And one of the things that you can delegate is activity, but you cannot delegate responsibility. So ultimately, the company is going to be responsible for its processes or lack thereof of good bookkeeping. I could throw a couple of ideas out there, like, for example, good bookkeeping. And again, this is a non-delegable thing. You can't just say, oh, my accountant handles it. No, it's on you. I'm going to point right in the camera. Whoever's watching, it's on you to implement this stuff. So first, you should not commingle personal and business accounts. Now, the issue that we see and where this arises a lot is when you have the 1, 2, 3, 4-man shops, right? And they're kind of operating as remotely out of a house, whatever it may be. And they think, well, you know what? Sometimes money is deposited into this account and then we immediately transfer it over. And they're sort of commingling things. That's a problem. Okay, that's a problem. And sorry for smiling when I say it's a problem. That's something they teach you to do in law school. They see a problem and you smile. It's, my therapist is working on it. So anyway, the issue with commingling, okay, is that if you're going to commingle personal and business, you know what you're doing? You are exposing yourself individually for personal liability, because the IRS, even one of your customers who may be disgruntled, might say, you know what? This isn't a real company. You're bringing in money, you're putting it in your personal account, you're moving things back and forth. You really don't have a company here. Your company is simply an alter ego of you as a person. And therefore, you're responsible. You're responsible for mistakes. You're responsible for tax issues. You're responsible personally because you've played fast and loose with the rules. So that's the first thing I would recommend, that if an MSP is doing that kind of commingling and kind of being lackadaisical or casual about it, that should stop. Like right now, probably the most important thing I'll tell you all day.
Excellent.
Question?
And then that's very helpful.
I have more. I just wanted to know if that's just blew your mind.
No, that's great.
Spot on.
Right. I'm sure too, when you are just a one person shop, you might think, oh, well, it's just me. But if you're mixing that together,
matter,
commingling, yeah, you need to separate out. I think that's excellent.
Right. You need to have a corporate structure around you, because remember, you're a business, and unless you're willing to expose your personal assets, whatever they may be, to mistakes that you make, including, by the way, tax issues, you need to have a corporate structure around you. You need to have separate bank accounts. You need to do separate bookkeeping, and we don't commingle things. So that's first. All right.
So that's throughout the year. And then thinking about right now, with it being tax season, it's the deadlines approaching. What are some of the to-dos that you recommend MSPs think about during this time?
So what I think an MSP should be doing is becoming very specific with its accounting firm. Now, what do I mean by that? I'll tell you this. Most accountants have no idea what an MSP is. They have no idea what a technology company really entails. They don't understand what you do or how you do it. Why is that important? It's important because you may have expenses that are unique to an MSP that are deductible, right? That can be taken off your income when you're calculating taxes. And your accountants might not catch it because they don't understand what you do. You know, if I told you that I sold water bottles, they probably understand you're selling a product. There are natural, ordinary business expenses and so on. But what if I told you that I'm a managed service provider, that I'm reselling services from third-party providers? I'm also providing services directly, and those are two different categories of things. I'm buying licenses that I'm reselling. Right? So there's a resale arrangement in there. And I'm also buying hardware and software. I'm acting as a VAR. So I'll buy it and then pass it right through to my customers. Most accountants would be sitting there going, okay, what? What did you just say? What's a VAR exactly? A VAR?
Right.
What is that? Is that like a bar?
Alphabet
Because
soup.
I'm into the bar thing. I'm not into the VAR thing. So, you know, the idea here is that you need to be very specific with your accountant to understand, to make sure they understand what you're doing. And along those lines, it's on you, MSP, it's on you to itemize your advertising and marketing expenses, understanding a lot of that's done online, right? A lot of that might be done in venues such as PAX Beyond 8, right? We're going to become a vendor and so on. We're investing in that. Accountants might not understand how this all works or all the expenses involved in that. You should be itemizing it. Processing fees for different third-party solution providers that you are reselling. License fees, equipment costs that you are buying not just for your business, but make sure they understand some of this stuff you're shipping out to your customer. You're not making a profit on it, or maybe you are. But the idea is you have to sit down with your accountant and explain this. Because if you think that most people don't understand what an MSP is, wait till you sit down with an accountant. They have no idea what it is. Right? So it's important.
I'm glad you brought that up. We see a lot in both in the peer groups and in the courses when we talk through, because most of the partners don't start off with a finance or tax background, right? They're technicians or technical. They start a business to do technical services. So learning about the finance and the taxes and the legal are secondary, right? They're as they go. So I'm really glad you brought that up, because it is something to know, is that within the industry, there are certain standards in how we track, best practices in revenue, cost of goods sold, and that the tax implications behind them are significant. So having that conversation and making sure you're aligned with it, don't just assume that your business is the same as the chocolate store or the bar. You brought that up. I don't know why, but other types
You
of
stuck
business.
with it, by the way. So,
Hey,
I brought it up, but you're going with it, and I'm just saying I'm okay with it.
Comfortable. I like that. I appreciate that about you. Yeah, very much. So I'm glad you brought that up. I know, Bessie, we kind of want to go into the next topic.
Yeah. I was going to say too, Chris, like it's so, I really like, Brad, that you brought up being specific, itemizing. I know, and when I've sat in peer groups before, Chris, that sometimes partners will have a big category called miscellaneous. And so
yeah, that should not be your biggest category.
And so it's helpful for your taxes and for your own business to know where your money is going. So I really appreciated that one.
Sure.
Exactly.
And, there's so much going on with all these different solutions that are out there, and you're mixing and matching client solutions, and you're buying and selling things and so on. To then turn around at the end of the year and say, okay, now what did I spend on what? You're going to miss, right? You're going to miss. So if you really want to save money on taxes and get the highest number of deductions, you're going to keep track of that all year. And I would suggest that you should be reconciling this type of stuff at least monthly. I mean, ideally every week if you're big enough, right? Or every other week, but at least monthly, to capture all the stuff that you did the month before. We're all very busy people in this industry. We really are. And it's not good if you're stuck at the point at the end of the year thinking, oh, so what did I do last February?
Yeah. And that really leads us perfectly into our next topic. So let's bring up the graphic. The next topic is all about how steps to reduce your tax burden. So you've started chatting with us a little bit about this, how every month, being very meticulous and writing things down. What are some other things that MSPs can do around reducing their tax burden?
So aside from the main one, which is making sure that you have the most deductions possible, keeping track of where you're spending things, how you're spending it, and defining the categories into which those things fit. So when you go to your accountant, he or she will understand, right? Or at least have enough education to ask questions about it. So that's the first thing. I mean, if we're going to talk about anything, that's up here. Everything else is sort of below that. Then you have other ideas. You could reduce your tax burden, for example, by paying yourself a salary. You have to actually pay yourself a salary under U.S. tax law if you're a C Corp or an S Corp. And so you're going to run that through your payroll like any other employee, and you're going to use that to pay your personal expenses. That's a strategy. I would also recommend, and this is a big one, suspending services to non-paying customers. How does that relate to taxes? Suspending services to non-paying customers. Here's how it relates. Wait, I gotta go. It's time. All right. So it was nice seeing all you guys. Part 2? No, I'm joking. Okay. Why does
please stay.
Maxine say the thing? They're going, this wasn't scripted. What's he doing? What happened? All right. So, all right. Depending on how your company recognizes income, and this is really up to your accountant, right? Does it recognize income when it's earned? Does it recognize income when you've signed up for a contract? Depending on how and when you recognize income, if you have a non-paying customer, right? Let's say you're charging that customer $10,000 a month. Well, on your taxes, it's $10,000 a month, right? You're making income $10,000 a month. What if that customer has been invoiced $10,000 a month and hasn't paid you in 8 months? right? You're still invoicing it. How is that being tracked on your income sheet, on your balance sheet? If you are the type of company that recognizes income as soon as it is invoiced, well, then you're going to end up paying taxes on money that you don't have, right? And then maybe you'll go after it in the following year. Maybe you'll get it back. Maybe you won't. If you don't, you write it off as bad debt. I get it. But the concept is, why should you have this issue, right? If a customer isn't paying you, then it just makes good business sense to suspend that customer and the services to that customer. We could talk about how that should be done. But from a tax perspective, don't incur income when you actually don't have money, right? And the best way to do that is to stop servicing a customer that's not paying you, cut off that account. So you're not, so income isn't attributed to you, even though you're not actually collecting. You follow me? You with me on that?
Excellent advice. Yeah.
There we go.
And a lot of it, how to handle that. Like, okay, what happened? There's a breakdown. Some of the client, what do I do? And I don't think we think about that suspend services from a revenue or a taxed perspective at all. So I think that adds additional color to the situation. Bessie?
That's it. It's all about
Yeah, I was gonna exactly. I was gonna say, and you might be continuing to invoice them, like hoping that something changes when really you can already tell that they're haven't paid for the last 8 months. Like likelihood, you're hurting yourself more and more.
There are statistics out there that, I mean, I don't have them in front of me, but I know that they say that an unpaid bill that goes for 90 days or more, the ability to collect on that drops exponentially. So, if you're 90 days, 120 days, 150 days, 180 days, and they're still not paying, but you feel bad because I don't want to cut their services, it might hurt their business. Well, one, you have to look at your agreement that you have in place with them to make sure you can and should do that. 2, you have to give them proper notice. But 3, realize what you're really doing is subsidizing their business while potentially incurring a tax consequence for yourself. And in my world, and this is a legal term, we call that frickin' crazy. Okay, that's a legal term. Comes from the case of State v. frickin' crazy. We'll talk about that.
Famous case, I believe.
Yeah, the famous case that I just made up. Yeah.
Well, there's one more topic we'd love to bring a graphic up for, and that is all about how to avoid mistakes. Quite a large category, I know, but I'm sure that you see MSPs making mistakes related to taxes all the time. So
related to a lot of things, including taxes.
Maybe to a lot of things. Like, can you share just
narrow the lens just a little bit?
Yeah, exactly.
Oh, how long do we have? Well, I'm going to give you one, and then I think I'll give you a longer one after our
later. Perfect.
I know, after our break. Okay. So the first way to avoid making a mistake is to budget. That is the number one reason why I see MSPs have a problem. They don't budget. Why? Because it's hard. No joke. Yeah. Because it's very hard to budget. It's hard to sit down and think about what you have, what you need, what you're going to spend on, and MSPs everybody avoids doing hard things. And it requires a lot of self-introspection too, right? About what you're actually going to make as opposed to what you'd like to. It forces you to look at certain realities, and that's hard. I mean it, I understand. But the failure to budget results in all kinds of financial troubles, most of which will end up being reflected in your tax returns. So in my view, budgeting at least per quarter, maybe not every month, but every quarter, if you're going to just go the bare minimum once a year, once every 6 months, maybe do that. But the act of budgeting will help MSPs avoid mistakes. It's the number one way to help avoid mistakes.
Excellent. And we do have a lot of, if there's anyone listening that's like, oh, I'm new to budgeting, we have a lot of resources with Academy to help you learn how to budget. There's a few instructor-led courses, so we'll talk about those more later. We do have a question in the chat I would love to pop up. Let's take a look. It's from Andrea Libby. Is there any prudence in sending a debt to a collections agency for non-payment?
Yeah. Yeah. I would think that, an MSP is not in the collections business. So, in my view, you ask once, you request a second time, you demand a third time, and at that point, in my view, you cut services and send them to a collections agency. It might sound harsh, and it might result in arguments by or from your customer. But again, if you don't do that, you are subsidizing someone else's business. And in truth, if you're making that much money that you can not only afford your business and subsidize other people's businesses, well, then maybe you need, a good financial planner, because you're spending your money in the wrong way. So I would say absolutely use collections agencies for sure. One quick
Appreciate
note.
that question.
Another reason, by the way, why you want a collections agency is because there are the Fair Credit Reporting Act and other federal laws require certain procedures to be done and certain communications to be made when collecting a debt. You don't want to run afoul of those. So demand, argue this, that, cut services. Then if send it to a collections agency or an attorney to then pursue the amounts, for sure.
Excellent. Well, I really appreciate the question from the chat. Before we move on to our next segment, Brad, are there any other mistakes that you wanted to highlight here that MSPs make they can avoid?
I mean, the other one is a failure to collect appropriate sales tax. And that is a major issue.
Big topic. Yeah.
That's a big topic. Do we have time for that right now? Should I wait for the next segment?
Let's hear it.
Let's start about sales tax, because a lot of MSPs have no idea what they should be doing, right? They heard at one time they didn't need to charge sales tax and remit sales tax to other states in which they are providing services, because unless you had a brick and mortar location, you didn't have to pay sales tax. And that's actually the way it was for decades, literally for decades. Unless you had a brick and mortar location, if you're providing services in another state, you didn't have to pay sales tax to the receiving state. Why? Well, because without getting into too much legal detail, but I know there are some people sitting out there that will, Google things, and they really want to become like armchair lawyers.
Oh, no.
It has to do with something called the Dormant Commerce Clause. I'm not explaining what that is, but if you're listening, Google the Dormant Commerce Clause, and you'll see. So up until a few years ago, you didn't have to collect tax. Now you do, okay? And, remit tax. Now you may have to. It depends on how large the transactions are, the service transactions are, how many of them are, and so on. The short version, back in 1967, Supreme Court said, unless you have a physical presence in a state, you don't have to pay taxes. In 1977, they did the same thing in a case called Complete Auto Body. And then in 1992, in a case called Quill, again, for those Google champions of Google, they'll look it up. You want to start with the Bellis Haas case, move to Complete Auto Transport, and then go into Quill. All right, see, I'm with.
And I'm like, and now it's time to move. Too many court cases.
Right, but I'm just throwing it out because there are going to be people out there going, Quill, huh? That's QWI. It's QUILL, 92 or so. And what that said was, the Supreme Court said, listen, unless you have a physical presence, you don't have to pay tax in the state in which you're providing services, because that would impact interstate commerce. And that's Congress's job, not a state. So a state can't do something that might impact interstate commerce. All right. But things changed, right? Over the decades, things changed. Back in 92 and 77 and all, there was no real internet. They weren't really, the amount of interstate service type was limited. Skip ahead, now everything's done online, right? Everything is done online. So all the states are saying, we're getting our butts kicked here. We're getting our butts kicked. We need the money here. We're not getting any money because everyone is buying from other places and nobody's giving us tax. So what happened was South Dakota. Leave it to South Dakota. You know, when you think of changes to the law, you think South Dakota.
Yeah.
Okay. Anyway, so that's going to be like a meme, maybe. I don't know. I'm going to take that and steal it. South Dakota passes this law. And what it says is that anybody who sells services or products into their state, okay, more than 100,000 in a year or more than 200 transactions. So it's either 100,000 or more or 200 transactions, you have to remit sales tax. And that was South Dakota's law. Wayfair, the company we all know, Wayfair, just what I need, right? Something like that. I sing better than that. I don't want to impress you, though, with my singing prowess. So I'm going to stay with that. They sued. And they said, wait, for decades, the Supreme Court has said, unless we have a physical presence, we don't have to pay tax. And here you are, South Dakota. You're saying we have to pay tax to you even though we don't have a physical presence there? So what happens is that goes to Supreme Court. Bottom line, Supreme Court basically says that whole physical presence thing, yeah, that's an anachronism. It's artificial. We're not staying with that anymore. Now states, if they want to, and it's an important point, if they want to, they can require out-of-state sellers, out-of-state MSPs, let's bring it to our audience, right, to pay sales tax for services that are delivered in that state, okay? It depends on the state, though. It depends on the state. For example, like I said, South Dakota has, and North Dakota, and I believe Virginia have $100,000 trigger amounts. So if you are if you're selling 100,000 more of services in that state, yeah, you got to pay sales tax. Okay. I know New York, I think, is $500,000. Again, don't check with your accountant. Don't just run and say, oh, I didn't do it. Right? I believe it's about $500,000 and so on. And if you're facilitating sales for others, that counts too. So the whole idea is that now states are imposing this sales tax requirement, but you have to hit a certain level. So I don't want every MSP to think, well, you know, we do service, we offer services. We're in Colorado and we offer services in California. We have to pay the sales tax? Well, no, you have to hit that trigger. If you're doing 100,000 or more in California, yeah, maybe you do. Yeah, maybe you do. So
you should definitely have an accountant to help you there.
Right. I mean, and, you know, if you want, I mean, there are sites online, and I could give you the site if you want, where they have up-to-date charts to show, like, if you sell this much or this number of transactions, yes, you have to remit sales tax and so on. But bottom line is, you have to talk to your attorney or talk to your accountant, because if you make that mistake, right? If you make that mistake,
costly.
That could cost you quite a bit. Yeah, penalties, for sure.
Excellent. Well, thank you, Brad.
So
I think we're going to take it.
I just taught everyone about tax law and the Wayfair case. It's
I learned a lot. We're going to move on to our sales pitch segment from Keith. He's going to talk to us a little bit about. We're going to hear that quote of the day again. We're going to learn some new things. So let's hear from Keith with sales pitch.
Play ball. You've heard the saying, 2 things in life are guaranteed, death and taxes. I will say one thing that's guaranteed in any organization is somebody on the leadership or operations team is going to slow down the sales team. Maybe it's a focus on doing activities that don't work and measuring those activities like cold calling or sending emails or cleaning up lists or the pipeline or having the perfect sales script. When I was a baseball coach, the worst thing I could do was interfere with a player that was red hot at the plate. One of the most cardinal rules in baseball is you never fudge with a winning streak. So why do sales leaders try to adjust the game of their successful salespeople? In IT services, many owners are responsible for generating new business. And when they hit north of around 2 million, they may look to hire a sales hunter. And all of a sudden they become a sales manager and they don't really know what they're getting into or really how to manage this salesperson. So let's touch all the bases for those who've been thrusted into the sales management role. 1. Hire sales reps with a high motor, then coach and train them. You can't coach work ethic, but you can coach them around your business. You want coachable students of sales with a work ethic. Find out what is inside them, what motivates them, and what's their main reason for drive. 2. Before hiring, set the sales territory, the commission program, and quotas. Changing any of those things is the best way to lose a good salesperson. 3. Have weekly one-on-ones with your sales employees. Get to know them as people. Schedule time to go on meetings with them. Get out in the field. When they're in a slump, ask them how you can help. When they talk to you and come back all excited about having new meetings, ask them, hey, who did you meet with? What'd you talk about? What are the next steps? 4, do not get consumed by the data. The number one thing to measure is revenue. That's why you're hired a salesperson. New business, achieving quota, instead of focusing on doing dumb sales activities and doing more of them, focus on the right things, doing them the right way to close more revenue. You have to work at sales. Taxes may be guaranteed, but sales are not. So let your salespeople thrive, and don't forget, make sure you file those taxes.
Play ball!
Well, thank you again, Keith.
Well done.
Exactly. Yeah, always learning another little interesting tidbit about sales, managing your sales team with Keith, but we're glad to have Brad back for a few more Q&A. We're going to have a few more questions. So let's bring up our first image here. We talked a little bit already about bookkeeping, so going to glide over that one and focus instead on estimated taxes. So how often should I pay estimated taxes, and how do I calculate them? Do you have any advice here, Brad?
Sure. So my first advice is you talk to your accountant, right? Because sometimes how you're going to pay and the rate at which you're going to pay and so forth will be subject to how you do your business and how you make your income and when you make your income. But, if you are, if you have income other than just pure employment wages, okay, then you may need to pay estimated taxes every quarter. And the IRS has set up a schedule for that, basically every quarter, right? Every 4 months, every 3 months, 4 times in a row, you are going to pay your estimated taxes. So if you have income, for example, that exceeds your wages, like interest income, dividend income, gains from sales and stock, which isn't that applicable to an MSP business itself, but personally it might be, earnings from a business, that kind of thing. Again, you'll talk to your accountant about it. You're going to want to pay estimated taxes quarterly. And the thing about estimated taxes is that if you estimate them wrong, you could be subject to penalties. So that's the reason why it is not something that you just want to say, when they say estimated taxes, they're not thinking about, gee, what should my tax be? What do I think my tax is going to be? No, it's a process. It's an algorithm, right? Based on your income, how much you exceed your salary and so forth. And that is something that is not for the evil of heart. You're definitely going to want a professional in there. Estimated taxes every quarter. And I think that you need to talk to your accountant before you even approach them.
Sounds like it's not as estimated as one might believe.
Right. It's not like, how much longer am I going to talk? Another, 20 minutes, 10 minutes. I don't know. No, you do that, right? Then the IRS is going to say, how much we're going to penalize you? Right? You don't want to go down that road. You don't want to be there. So for sure.
Well, if we could bring up another one, I kind of want to bring up the next one. It's about tax deductions. And I think there's probably a lot to talk about here. And I think some things that could be really creative. But talk to us a little bit about tax deductible expenses, kind of restrictions. What have you seen? Where have you seen people struggle or get in trouble And then after that, we can go into any things about communications tasks, because that's, can be complicated. But let's start with deductions.
So deductions, you're in any business, MSP or otherwise, you are allowed to deduct ordinary and reasonable costs of your business. So what might that be? Okay, ordinary and reasonable. Let's just pick a law office, right? Okay, well, I have a lease, right? Rent, I have to pay that. Insurance, I have to pay that. Employee salaries, right? Those are expenses. Licenses, malpractice insurance, all these kinds of fees that are ordinary and reasonable to a service industry can be deducted. Now, where MSPs start to get into a little bit of hot water, like, by the way, any service company does, okay, is where they start to commingle, or at least sort of fade the line between what is personal and what is business, right?
Yeah.
So, for example, if I have to go to speak in California, so what's an ordinary and reasonable? Is that ordinary and reasonable for my business? Well, sure it is. I mean, we promote ourselves in different states. We provide education to people around the country. So, yeah, the flight would be deductible. The hotel expense would be deductible. Meals, the things that one would expect. Now, while I'm out there, okay, if I say, oh, I'm going to go to Disney World or Disneyland, because we're in California, right? Can I deduct that? Because, hey, I'm out there for... No. Obviously, that's personal. What if I bring a client with me, right? Now, is it deductible? Well, now you're starting to play fast and loose, right? Because you could say, well, it's client entertainment. Is it client entertainment to take them to Disney World or Disneyland? So this is where MSPs start to get into trouble, right? I went out to dinner out in California. I bought myself a $50 steak, and I also bought myself a $1,200 bottle of wine. That's what I did, because I like wine. I really don't in real life, but, we're just talking.
If anyone's getting you a gift, yeah.
Yeah. Wow, New York came in. My New York accent came. We're just talking here, okay? We're just talking about the wine. So we're out there. We're going to get ourselves something. So I buy myself a $1,200 bottle of wine. Is that reasonable? Is that ordinary and reasonable expense? Well, I'm sure there is an amount of beverage and food that is reasonable, but a $1,200 bottle of wine probably wouldn't. Now, I'm not saying that the IRS, I'm sure the IRS is not interested in your $1,200 bottle of wine on one occasion and one event. That's not my point. My point is that MSPs would be well advised to just generally not abuse it, right? Make what is business, what is normal and ordinary. Keep track of that, like we talked about earlier. You're going to tell that to your accountant. And don't abuse it. And if you're going to abuse it, then realize you're gambling, right? So ordinary and reasonable tax deductions are, like I said, travel, reasonable meals, a car if you have to get around where you're going. But don't assume that just because you're in a location for business, that everything you then do at that point is a tax deduction, because it's not.
So I want to pause on that one, because I know this comes up in conversation a lot. Company car versus mileage or use or maintenance and things like that. Again, not trying to throw a curveball, so to speak, but maybe what are some things you've seen businesses have to either respond to legally or tax wise, or have to consider when they're making some of those decisions, whether it's for themselves, their cars, or employees? Any advice or thoughts?
Well, I personally have a fleet of cars that I write off, because I might want a different car every day to drive to the office. And if the IRS is listening to me, I'm joking. That's a joke. Okay? That's a joke. All right. So, when it comes to things like company cars, and so I might regret that joke. No, some IRS agents sitting there going, I don't think he's joking. I think he has a fleet of cars. Anyway, so things like cars and so forth, where they're part work, part personal, well, you have to allocate between the personal and the work. For example, if you work out of your home, right? You have a home office. Does that mean your mortgage payment and everything you pay for your home is deductible? Well, no, of course not, because you also live there. So, but you can allocate a portion of whatever your expenses are because it really is your office. If you have a car that you use for both personal and business, and by the way, business is not, well, I drive from my home to my business and back. That isn't business. That's personal. Business is I use it to drive from my office to my clients back to my office, right? That's business use. Again, these things have to be apportioned, and where service providers and all taxpayers run into problems is they just write off the whole thing, saying, yep, this is business, even though they're using it for personal. You can't do that. Okay, so that the idea is you talk to your accountant and expect that things are apportioned. It's not just wholesale, we're writing it off because, hey, you used it for business once. That's where you're going to run into problems.
Makes sense. Mm-hmm.
Definitely. Well, our last Q&A we had here was about communications tax. If we could bring that just back up for just one moment, let's take a look
God,
at
you actually
it.
had a whole Q&A about communications tax?
Communications tax? Yeah. Is this something that you are
Who the hell wanted to talk
seeing?
about that?
Well, you know, people have questions.
A whole
People
show on
do have
communications
questions.
tax? I'm going to go kill myself now. Thank you.
Oh, no.
What? I mean, look, here's the deal with communications service tax. And to be honest now, it is a very, very complex subject. I mean, it's not something that we could just say, we're going to summarize it in 60 seconds and here it is. No. Why? Because there is no such thing as a single communication service tax. It does not exist. If anybody says, yeah, I just paid a single tax into my local government, then they're missing the boat, because there is no such thing as a single communications tax. It actually, communication service tax refers to a conglomerate of taxes and fees and surcharges. And all of those fees and surcharges are charged by the federal government, the state government, where you're located, local levels. Sometimes you have to pay sales tax on income from these things, and use tax and so on. So it's all done, you know, it's such a web of different things that just simply say we have, we have one solution for communication service tax isn't going to work, right? So that's, we'll start off with that. I'll tell you that, when it comes to Unified Communications as a Service providers, right? UCAAS. Did I get that right? UCAAS, right.
Very good. Yeah.
Thank you. Yeah, that was off the, that's
Off
fine.
the cuff. Good to see, yeah.
It's, I'm good at figuring out 5-letter words like that. UCAAS. That was 5 letters, thank God. Or I'd get emails on that for sure. So figuring out which UCAAS features that you're offering are taxable is really something that is being debated. I have spoken to lots of tax attorneys about this particular issue, and they all have, well, not all different opinions, but I've heard at least 2 or 3 different opinions. Okay. Some argue, for example, that calls that are routed to a voicemail should be taxed like an information service, whereas calls that are answered by people are subject to taxes like a phone call. Who's right? I don't know. Really, I really don't know. That's not just rhetorical. Like, I don't know. No, I really don't know. And it gets confusing because sometimes service providers will present a UCAAS service as if it were a normal phone system, when in fact, it's not. And in fact, calls can be delivered to other phone systems and so on. So, this is one of those things that you sort of have to whiteboard out and talk to your attorney about, your tax attorney or your accountant about, because where we say it's a matter of debate, what that really means is at some point someone's going to get challenged by the IRS and make case law out of it. But until that happens, we're all sort of giving our best educated guess about what is due and when, right? I called you
And then
on a
it'll
VoIP
be-
line, but it went to your voicemail. Is that taxable? I don't know.
And then on a
Could be.
future show, it'll be another one of those cases that Brad can tell you to go look up, right?
Right.
That is correct.
And another area I'd like to get your input on is you talked about how, you know, sales tax, there's kind of a point where all of a sudden there's revenue missing because everything's bought elsewhere. So now we change
Right.
that. What are you seeing as trends as far as it used to be product being taxed? Now, where are the lines being redrawn as far as service being taxed? You know, managed service components. And if you call something in your bundle a license, now that license is taxable in certain laws. What kind of trends and activities are you seeing in that? And have you seen how people are responding in the MSP space?
Well, I'll tell you this. I mean, I think that, you know, with regard to these issues, there is a part that the part of what I'm going to say is you shouldn't freak out. Okay. And I'll tell you what I mean by that in a moment. And then there's a part that says, but you have to take it seriously. For example, like I said earlier, under the Wayfair case, which came out now 6 years ago, I believe, if my math is done correctly, states can now require MSPs, out-of-state service providers, to collect and remit to those states service tax. Okay. So you'd say, oh no, this is the world's going to end. I have to pay tax to every state in which I'm providing a service? No, actually, because one, most states, there's like 2 or 3 that are an exception. New York might be one, where, you know what, you have to hit a certain minimum level, right? It's either a minimum level of income or it is a minimum level. Live TV, that's what it is. I'm getting messages. You have to hit either a minimum level of income or a minimum number of transactions, of separate transactions. An ongoing service is not a separate transaction. It's one transaction, right? I'm providing an ongoing service to you. That's one transaction. I keep doing it month to month. That's not month to month transactions. Okay. So my point is, we don't have to freak out about this stuff. It's not like suddenly there's these laws imposed and Big Brother is looking at you and wants your money. At the same time, you know, MSPs are becoming more ubiquitous. They are providing their services with greater frequency in larger and more geographically isolated locations. And at that point, well, now you might be in a state where they are going to keep track. And you very well might be making more than 100,000 or 200,000, whatever the trigger point is. And you have to keep track of that, right? So I see the trends as the IRS is going to require you to keep better books. Really, that's what I see. The trend is you're going to have to use technology to keep better books about how many services are being provided, the types of services, the frequency, and the money collected. That's the trend. I don't see a trend of, oh my God, this time next year I'm paying so much more in tax. I don't see it that way.
Good. Thank you. Great. I appreciate that.
Mm-hmm.
And Brad, we have another question from someone in the audience. If we could bring up that question. So Zach asked, what's a good way to calculate a salary if your business is feast and famine, depending on the time of year?
So, you know, the whole idea about salaries is every company is required to, you know, C Corp, S Corp and all, you have to pay a salary. How much? That's really what you're talking about. And can that salary change depending on the income of the company? Again, I'll give my thoughts on it, but I'm telling you, you got to talk to your accountant, right, and get his or her opinion on that. You know, my thought is, look, if your salary, you know, generally speaking, salaries are not supposed to change. That's why it's a salary, right, as opposed to like an hourly rate. If you work for me by the hour, this month I might give you $100, next month $200. the month after that 50. A salary is usually calculated over an annualized basis. And in my view, you should not be moving that salary up and down. I would rather see that you keep a salary that will keep that line level instead of the roller coaster, and then bonus that person, right? Give that person other ways of compensation if they say my salary isn't enough. You know, I could raise you up here and then drop you down here, or I could just keep you level. And at some point, maybe halfway through the year or quarterly, we'll reconcile it and we'll see. You know, maybe you get a bonus, maybe you get something like that. That's how I would do it. I would not just adjust the salary, because then it looks like you might be playing fast and loose with the numbers. And that's a red flag.
Excellent. Well, we're getting close to our end of our time, Brad. So is there anything that we didn't get a chance to ask you about, or that we didn't cover that you think is really important, or any piece of advice or anything you want to leave our audience with?
Yeah. Well, let me think. I think that one of the things, look, sort of the closing bit of advice is this. And this goes to not just tax issues, it goes to contract issues, legal issues, accounting issues. Here's the thing. Insurance, by the way, what I'm about to say applies to that. MSPs, you know, there's an expression, you never have time to do it right, but you always have time to do it again, right? You never have money to do the right thing, but you always have money to fix what you should have done in the first place. I think that when it comes to accounting, when it comes to law, when it comes to all that stuff, you need to make the investment, because the penalty ain't worth the amount that you have saved. If you have a service company that has crappy agreements, you think, well, I'll get them fixed one day. No, because one day, when that one day happens, it's usually going to be as a result of someone not paying you, right? Or someone threatening you with liability that would be company ending. That's when you're going to first do it. Probably worth investing in a lawyer in the past, right? Same with accounting. I can appreciate, I really can, all of the TurboTax, you know, the automated software tax stuff. It's all good stuff. I mean that. It's good stuff. But there comes a time when you're beyond that, when you're more mature, where there are other deductions you should be taking. And that you need to sit down with someone and explain what it is that you do. So you're not just this anachronistic thing that, yeah, I used to know what you do. I don't know what you do anymore. I'm not sure what you do. At that point, you have to invest in an accountant, in a bookkeeper to keep track of things, and an accountant that understands what you do. And you know, you say, well, they're expensive. Yeah, but so is my hourly rate, and so is right, and so is fighting a tax battle with the IRS. You think, you know, you think I'm expensive? Go look at that. So my point is, that's my advice. Make the investment up front. It pays exponentially well.
Couldn't agree more.
Thank you so much for coming on our show. You're an amazing guest. We hope to have you on again in the future. You're amazing. Thanks so much.
Tomorrow.
And we'll see you next time.
Tomorrow.
Thank you.
Tomorrow.
We'll talk about other things.
Perfect.
Thanks, Brad.
All right, let's move to final thoughts. All right, Chris, what are your final thoughts here?
You know, I love what Brad said at the end right there. Usually, you know, when we think about it, it's almost too late, right? We wait.
Right.
And I think, you know, what I think for me, it's not just that, but some of those things with the relationship, you know, trying to find a plumber at the last minute when you've got something bad happening, or a lawyer, an accountant, you know, building those relationships before something is urgent is really important. And taking the time to kind of to do it right, the right way, and establish the right questions, the right alignment with your business, it's worth that time and energy. Have those resources, have those relationships with those key people that are going to help you in those aspects of the business: legal and law, tax, CPA, planning, bookkeeping, and finance. Seek those out, build those relationships, and don't wait till you have to and it's last minute. Bessie, how about you? Final thoughts?
I think the two things that really stood out to me were around budgeting and bookkeeping. So I would say if those are two things that you are not focusing on right now, really dig in, take the time to make it a practice. Not just wait till the end of the year. You want to be doing both those things every month, every quarter as you go. So those are two big takeaways for me. And now I can say thank you so much for watching, and be sure to check us out next week when we talk about MSPs who work in the nonprofit space and how valuable the nonprofit vertical is for MSPs. Our guest will be Matthew Bauer at Better World Technology, so really excited to talk to him. Make sure you tune in live every Tuesday at 2 p.m. Mountain Time, or you can watch us back on demand always. Please don't forget to like and subscribe to our YouTube channel. Chris, you want to close us out?
Absolutely. And like Chris would want to ask everybody, what are you going to do differently tomorrow to improve your business? Thanks for watching, everybody. Take care.
Bye.